For decades, the United States has been the undisputed leader of the global economic order. But recent reports from the International Monetary Fund, or IMF, paint a pretty concerning picture: rising deficits, declining demand for U.S. debt, and a growing push for a more balanced global system. Is the U.S. losing its grip, or can it adapt to a changing world? Let's dive into the key issues. The IMF has put a spotlight on the U.S. economy, and honestly, the numbers are hard to ignore. The U.S. current account deficit has ballooned to a staggering $1.13 trillion, the largest in over a decade. This means the U.S. is importing far more than it exports, spending more than it earns, and borrowing the difference. A deficit of this magnitude isn't just a domestic issue, it has significant implications for global markets, as the U.S. dollar still anchors international trade. The IMF warns that this isn't a short-term problem, and that without a plan to reverse it, trust in the system could erode rapidly. The U.S. has attempted to address its trade imbalance by imposing tariffs, aiming to make imports more expensive and protect local industries. However, the IMF argues that this strategy isn't working. Prices inside the U.S. are rising, export growth is weak, and the trade gap continues to widen. Tariffs, intended to reduce the deficit, have instead made American goods more expensive and triggered pushback from trading partners. The IMF emphasizes that tariffs don't fix global imbalances. They distort them, pushing prices up, disrupting trade, and masking deeper problems like poor export competitiveness. The U.S. relies on selling treasury bonds to finance its deficit. However, this safety net is showing signs of strain. Foreign demand for U.S. debt is slowing, with countries like China and Japan reducing their holdings. The IMF data indicates a weakening flow of capital into U.S. debt markets across the board. This shift puts pressure on interest rates, the dollar, and the entire U.S. financing model. While not a full-scale exit, the trend is real, with more countries diversifying their reserves into other currencies. The U.S. dollar remains the top global reserve currency, but its dominance is not untouchable. The IMF and other financial institutions have observed a gradual shift away from dollar dominance. Countries are diversifying by settling trades in local currencies, increasing gold reserves, or turning to the euro and yuan. While the IMF isn't predicting a dollar collapse, its reports suggest a long-term trend of eroding demand as deficits grow and confidence in U.S. fiscal discipline weakens. In April 2025, U.S. Treasury Secretary Scott Bessent publicly criticized the IMF, accusing it of mission drift and underestimating the economic fallout from global imbalances. This unprecedented move signals a changing relationship between the U.S. and the IMF, an institution the U.S. has historically led. Washington is frustrated by the ballooning deficit and shifting global trust, questioning the institutions built to support U.S. leadership. The IMF, while not firing back directly, hasn't backed down, highlighting a growing divergence between its recommendations and U.S. government policies. The IMF's July 2025 report points to a fundamental shift in the global financial structure. The model built around U.S.-led institutions and a dollar-based trade system is evolving as emerging markets drive more global growth and new regional development banks emerge. So, emerging economies like India, Brazil, Indonesia, and Nigeria are, really pushing for greater representation within the IMF. They're demanding quota reform to better reflect their growing share of global GDP. This push, it challenges the existing power structure, where voting rights are still heavily tilted toward advanced economies, especially the United States and Europe. As the global system evolves, the United States faces a critical decision. It wants to maintain leadership at the IMF, but, it's still reluctant to relinquish its voting share and institutional control. The lack of a clear U.S. position on quota reform really risks portraying the U.S. as defensive, clinging to the old model instead of, shaping the next one. The IMF is making room for others, and Washington needs to demonstrate how it plans to lead in this new environment. The IMF's July 2025 report offers clear recommendations for deficit economies like the United States: targeted fiscal tightening, smarter industrial policy, and investment in export capacity to reduce structural imbalances. Strengthening long-term stability by lowering government spending in non-productive areas, shifting from consumption-driven growth to production, and restoring competitiveness. However, the U.S. has yet to move in this direction, with spending remaining high, the trade gap widening, and policies like tariffs, well, failing to address the underlying issues. The United States has long been the cornerstone of international finance, but its control was never guaranteed. It depended on credibility, consistency, and alignment with global priorities. Now, that foundation is under strain. The IMF's data reveals rising deficits, declining demand for U.S. debt, and growing calls for a more balanced system. The question is, can the United States adapt and lead in a multipolar world, or will it cling to the past and risk losing its influence? The world may not wait for Washington to catch up.
What do you think? Is the United States still in control of the system it built, or is the world already moving on? Share your thoughts in the comments below.